You know when you're reading the fine print and some three-letter acronym just makes your eyes glaze over? Yeah, we've all been there. Well, today, we're going to tackle one of the big ones, MVA. It's a key part of a lot of annuities, and by the end of this, you'll know exactly what it means for your money. Let's get right into it.
So picture this. You're looking at an annuity, and you spot that little phrase, subject to MVA. What's the first thing that pops into your head? Is it some kind of hidden fee, a penalty? Is it a good thing or a bad thing? You know, those are exactly the right questions to be asking, and we're about to answer them. All right, so what in the world is a market value adjustment, or MVA? Just think of it like this. It's a feature that tethers your annuity's value to what's happening with interest rates out in the broader market. But, and this is the most important part, it only kicks in when you take out more money than your contract allows and only during a very specific window of time. Okay, that naturally leads to the next question. Why even have this thing? Why does it even exist? Well, it all comes down to a really big trade-off. It's a give and take between the insurance company on one side and you, the annuity owner, on the other. See, the MVA is basically a two-way street. For the insurance company, it's a kind of safety net. It protects them from losing a bunch of money if interest rates go up and everyone decides to pull their cash out at once. But what's in it for you? Well, by you agreeing to share some of that risk, the company can turn around and offer you a higher guaranteed interest rate from the get-go. It's the classic risk-reward deal.
Now for the really interesting part. How does this whole thing actually work? The best way to picture it is to think of a seesaw. On one end of the seesaw, you've got the interest rate from the day you bought your annuity. And on the other end, you've got whatever the current market interest rate is today.
Okay, this slide right here, this is the absolute heart of the matter. It's a totally inverse relationship. If you have to take money out early and interest rates have gone up, the insurance company has to sell their older, lower rate bonds at a loss. The MVA basically passes a portion of that loss on to you. But, and this is the cool part, if rates have gone down, their older bonds are now worth more, and you actually get a piece of that gain.
So if you remember one thing, let it be this. Just burn it into your brain. Rates go up, your MVA is negative. Rates go down, your MVA is positive. It's really that simple.
Now I get it. The idea of a negative adjustment sounds a little scary. But the good news is the MVA doesn't apply to every withdrawal, not by a long shot. There are some very clear rules of the game here, so let's walk through them. So as you can see, the MVA does not touch your normal penalty-free withdrawals. It also vanishes completely once your surrender period is over. And maybe most importantly, it has no effect on the death benefit. It really only comes into play if you need to break the contract and take out a large sum of money early. Let's just double-click on that last point for a second, because this is a huge relief for a lot of people. If you're using your annuity as a tool to leave a legacy for your loved ones, the MVA is a complete non-issue. Your beneficiary gets the full account value, period. No MVA, no surrender charges. Okay, so we've covered the what, the why, the how, and the when. Now we get to the single most important question. Who is this actually for? Is an annuity that has an MVA a good fit for your financial plan? A good way to figure this out is to compare it to something similar like a certificate annuity. That kind of annuity has no MVA. It's super predictable, but that predictability usually means a lower interest rate. The MVA annuity, on the other hand, gives you a shot at a higher rate, but it comes with that risk if you have to withdraw early when rates are climbing. So, who is the perfect person for an MVA annuity? Well, it's really for the disciplined saver. The person who's confident they've got other funds and won't need to raid this account before the term is up. If your number one goal is locking in the absolute highest guaranteed return you can find, the MVA is the feature that makes that possible. All right, let's wrap all of this up and bring it home. I'm going to give you one final thought that I think perfectly captures the entire concept of the market value adjustment.
At the end of the day, the MVA is all about commitment. It's designed to reward you with a better rate up front for promising to stay the course. But if you have to leave the party early, and the timing isn't great, it's also there to protect the insurer.
And that right there, that's the big question you have to ask yourself. There is no one-size-fits-all answer here. It all comes down to your personal finances, your long-term goals, and your discipline. So, is that promise of a higher return worth giving up some of that flexibility? Once you answer that, you'll know if an MVA annuity is the right move for you.